By early 2026, India looked like an economic fortress. It was the fastest-growing major economy on Earth, sitting securely on a massive cushion of nearly $700 billion in foreign exchange reserves. Then, in February, conflict erupted in West Asia. This stylized map shows the Strait of Hormuz, a narrow maritime corridor that suddenly became an impassable choke point. With that closure, 10.5 million barrels of oil per day were abruptly shut out of the global market. While peer currencies like the Taiwan dollar and Thai baht actually strengthened in the aftermath, the Indian rupee collapsed, hitting record lows near 95.80 to the US dollar. So how does a maritime blockade 2,000 miles away effortlessly crash the currency of a booming economy? And why is the worst financial pain for Indian consumers still waiting in the wings? The answer starts with a single glaring vulnerability. India produces very little of its own energy. The country is forced to import nearly 90% of crude oil. International oil is priced exclusively in US dollars. As global crude spikes over $100 a barrel, the stack of dollars needed to buy that same volume multiplies rapidly. To get those dollars, importers sell rupees, mechanically forcing the rupee into a steep decline. A falling currency creates panic, triggering a secondary wave of damage known as capital flight. Foreign institutional investors, who watch their returns shrink every time the rupee depreciates, rushed for the exits. They pulled over $21 billion out of Indian markets, selling off even more rupees to buy dollars, which only deepened the currency crisis. Strong domestic growth rates and high reserves offer zero defense against a runaway negative feedback loop, when an economy relies entirely on other nations for its fuel. If crude oil costs have surged so dramatically, you might be wondering why the average Indian citizen hasn't seen a massive spike in inflation at the grocery store yet. That stability is an illusion engineered by the government. State-owned oil marketing companies have been ordered to completely freeze retail petrol and diesel prices at the pump. But shielding the consumer comes at an enormous hidden cost. Right now, those state oil companies are quietly absorbing losses of 1,000 crore rupees every single day. The Reserve Bank of India has issued a stark warning that this dam must eventually break. The government cannot absorb the true cost of global energy forever, making a retail fuel price hike inevitable. When those frozen prices finally thaw and spike, the cost of transporting and distributing goods will surge with them. That logistic shock will unleash unavoidable inflation across everyday household consumer goods. To delay that shock, the government is deploying expensive, short-term defenses. The Reserve Bank of India is actively burning through billions of dollars in its own reserves, aggressively intervening in the foreign exchange market to manage the currency's volatility. Policymakers are also desperately trying to plug other dollar leaks. They've hiked import tariffs on gold and silver to a steep 15% to discourage buying. The pressure is so severe that the Prime Minister issued an extreme public austerity plea, asking citizens to voluntarily halt all gold purchases to protect the nation's foreign exchange reserves. Normally, a central bank might fight inflation by raising interest rates, but this diagram shows the impossible trilemma of economics. The RBI cannot use domestic interest rates to cure a purely imported, supply-driven energy shock without crushing domestic growth. The only real cure is structural immunity. India is now accelerating massive investments in coal gasification and pushing forward a $4.8 billion subsea gas pipeline directly from Oman to bypass maritime choke points entirely. The currency crash of 2026 offers a brutal lesson. A nation's internal economic strength is nothing but a fragile facade, as long as its energy security remains tethered to a single vulnerable passage